To a quick episode of the Capital Gains Tax Solutions podcast, also stream on Expert CRE Secrets podcast. And today we're talking about deferred sales trust basics. It always starts with good fundamentals in anything we do in life. In fact, Dan, we were just talking about, and by the way, I'm Brett Swarts, founder of Capital Gains Tax Solutions, for those that don't know me. And this is Dan Palmer. Dan Palmer is a top leader here at Capital Gains Tax Solutions. He actually just came on about a month ago, so it's about 30 days. And he will be helping to run sales, operations, and really everything within the company, which is really exciting to have you with me, Dan. But Dan, today we're going to be talking about all things deferred sales trust, but the fundamentals. You mentioned a story to me today that really caught my attention, or this week. We're talking about Del Curry and what he did with his sons, Steph and Seth.
So if you guys know us, Brett and I both love basketball. Brett played in college. I played all growing up. I don't think I was good enough playing college, but I also went to UCLA. So you have to be a really high level to play there. But I like sports analogies. And so I was reading this article this week about Seth and Steph Curry and what Del Curry did to get his sons prepared to follow in his footsteps into the NBA. And he said when they were young, when they were, first old enough, he put them in the AAU circuit and they were really good, but he went to the first game and he just watched them running up and down the court, chucking. There wasn't a lot of fundamentals going on. There wasn't a lot of basics. There wasn't a lot of team play. It was just kind of individual talent and ability. And it was obvious that his sons had it. But that isn't really what he wanted for them to go to the elite level of basketball. And so he pulled them out and he put them with trainers who only worked on fundamentals with them, dribbling with both hands, dribbling through cones, passing drills, bounce passes, chest passes, like all the things that for a child of that age would probably sound boring, but are the building blocks of great playing. And so when they hit their junior year, he allowed them to go back into the AAU circuit. And of course they were amazing. Steph was super small, so he ended up going to Davidson. But if you watched March Madness, the small school Davidson is playing in March Madness against the Titans of basketball, and Steph is just dominating the game. And Del was saying that he attributed a lot of that to mastering the fundamentals when they were young and they just wanted to run and gun, but having a leader that said, slow down, let's learn the basics, let's get a foundational understanding of all the different parts of basketball, and then you can go out and it will all come together and you'll reach an elite level.
Absolutely love that. Yeah, it really sounds like and feels like that Del, obviously, being that he was in the NBA, had a vision for where his kids could go and saw that something wasn't working great with the AAU traditional way. And he said, let's just spend all of our time and energy maximizing the fundamentals, which is exactly what we're going to do today with the deferred sales trust. And we're going to invite you in to dive in with us. The jump stops, the pivots, the right hand, the left hand, the boxing out, right? The closing out, the triple threat, all of the things that you would learn on basic fundamentals for basketball. We're going to try to do the same thing with the deferred sales trust, which starts with asking just the basic questions. Dan's kind of been introduced to the deferred sales trust for about 6 months, but really about 30 days ago is when he kind of did the deep dive as he came on full time. So Dan, A, what questions do you think someone might have as far as basics right now? And B, what questions do you have at this point, 30 days in?
It's such an amazing, benefit to people that are exiting high equity investments. And so I've just been blown away, but there's a lot of terminology and there's a lot of details that kind of were tripping me up in the beginning that I'm sure our listeners will feel the same way about. So, maybe defining some terms in the beginning. I've heard you say that the DST is a seller carryback combined with a business trust. Can you explain how that works?
Absolutely. So the foundation of the structures was called an installment sale, or IRC 453, which is known as a seller carryback, where a seller can become the bank. So the best way we typically know banks when financing is on like an investment property or a business loan or a primary house, where we're asking the bank to loan us the money so that we can go buy an asset, right? We can give a down payment and they can give the rest of the loan. Well, now once you own the asset, you want to sell the asset Well, guess what? Especially if you have a lot of gain, a lot of equity built up, then you can become the bank, right? You can loan back to somebody else. And that's the foundation of an installment sale, meaning you're going to take in installments, smaller amounts over time, and pay tax as you receive it. Now, it's coupled with the business trust. We use the trust as the entity. There's thousands of different types of trust. This happens to be a complex business trust, which basically kind of more resembles a C Corp or an LLC type of entity than it does what we would think of typically like a living trust, which is something you set up for probate. But that trust itself is a single entity that only does business with you, and it has a third-party trustee. That's our role to be able to actually transact and make this thing work. So hopefully that answers the question, Dan.
Yeah. So seller carryback combined with the business trust. I also heard you say it's an installment sale coupled with a trust. I think in the beginning I would get confused because those two things, I believe, mean the same thing. And it allows the seller to become the lender. How does that impact your investments going forward?
Yeah, well, great question. And you're exactly right. Those two are interchangeable, right? On an installment sale, right? And also seller carryback, right? So those are interchangeable for sure. Well, the neat part about the trust is the investments can be whatever they would have been after you sold and didn't use the trust. In other words, the trust itself, it's if you think about it, it's the wrapper, it's the product. The investments are inside of the trust, but it can really be anything. It can be businesses, it can be real estate, it can be securities, it can be cryptocurrency, it can be lending. So it's agnostic to the investments themselves. Just as if you sold it, just paid your tax and invested in all those things too. That's the neat part. And in fact, that's typically what we say to folks. We give an analysis and we say, well, what would you have gone into? And they go, well, I would have went into real estate or business and some securities. Great. Why don't we do a very close match or mirror to what you would have went into? And they go, oh, that sounds good. And so we do what they've already done. Even sometimes they go, well, what do you have going on right now? Great. Why don't we kind of match and mirror that? That's been successful for you. In other words, we like to keep and help and encourage people to go into things they've already invested with, they're already comfortable with. But in this scenario, they got 25, 30, 40, 50% more in proceeds, right, into the trust that they would have paid in tax. And so does that answer the question on that, Dan?
Yeah, it does, for sure. Thank you. Another question I had, in the beginning, about 30 days ago when I started deep diving into this, I'm sure I had the same question that a lot of your clients have, like, wow, this sounds too good to be true. Like, is it legal? And, I've heard you say that it's based on federal IRS code 453. Can you tell me a little bit about that code, how that works and how you utilize it?
Yeah, good question. So 453, let me take a step back too. So there's codes that we're very familiar with that you may not be aware of. There's IRS code, basically 401k, right? That's a code that most of us know towards retirement, right? Where we can put money in and we can defer, income and capital gains tax until a certain period of time. And there's a minimum required distribution. And this is for employers to incentivize their employees to apply into this plan, right? And this plan helps you to defer tax, right? So we know that. We also know IRAs typically, right? IRAs. We know Roth IRAs, right? These are all part of the tax code. Now, there's also one called the 1031 exchange. That's one that most of the real estate investors know about. And then there's IRC 453, which most people may or may not know about it. They more know about it as a seller carryback. But giving some history on this 453, if you go all the way back to like the Great Depression, if you remember, or if you look in the history books, what happened was these banks seized up, right? Capital seized up, the stock market crashed, and basically there was no real capital to lend and no one could get money. In a lot of businesses, the whole economy came to a crashing halt, right? And as a part of that, they looked at ways to incentivize the economy without requiring government to be a part of it. In other words, they said, is there a way where we can say and encourage someone who has a $50 million net worth to lend or to sell an asset, or a $10 million or a $1 million net worth, whatever it was? How do we incentivize, so in case this happens again, we want the people to be able to lend more and be tax incentivized to do that? Well, the government can't force commerce. They can't force us to sell properties or businesses. And so they say, but we can tax incentivize them to do it. And so 453 is based upon that premise that should the market and should banks stop lending, that it wouldn't completely stop the economy, because us as the people can lend on our equity while deferring the tax. And this is also why we believe the structure and the foundation is rock solid, right? Because it's the foundation, perhaps, of the of the American, economy, in case things go sour again, right? Which it could very well be where we're at. We're a lot of uncertainty going on right now, right? So that's a little bit of the history. But long story short, you can look up IRC 453, and you can Google search that IRC code 453. And it's simply going to tell you, the legal aspect of it and what it's all about. Some things to really keep in mind, that you want to make sure you understand your basis is, your adjusted basis, your debt. There's different rules about this. 453 also has a rule where if you're married, 10 million per year is what you can basically defer in a given calendar year. If you're single, it's 5 million, and above and beyond that, there's an interest charge. Okay. Now we have another structure that's outside of 453 that there's no limit and no interest charge. It can be $1 billion deal. But that's really it. It's basically a rule that allows you to defer capital gains taxes and pay taxes over time, that the government has incentivized us to do, so more transactions would move.
Yeah, thank you for that explanation. That's fantastic to hear. And the reason I bring it up is because I've got to sit in a lot of these meetings with you, and I'm watching these people wonder, like, wow, this sounds too good to be true. And then they see, oh, this is based on the actual tax code, and you just gave the reasoning why the government would push this in this direction. But it's so incredibly beneficial for people, and I've really loved watching the light bulbs come on, and they're realizing, wow, there's other vehicles I've been utilizing. And this is my next question. One of those vehicles is a 1031 exchange, and they kind of have to cram their needs into that vehicle because that's the one they know about. And then they hear about the deferred trust, and it opens the doors to so many other avenues for them to benefit and increase their wealth. And so, can you talk about the difference between 1031 exchange and what we can offer with the deferred sales trust?
Yeah, this is important, right? Because the 1031 exchange is something that, unfortunately, the real estate industry, and I'm a part of that. I grew up in the real estate industry. I'm a real estate broker by trade. I started at Marcus and Millichap as a broker for multifamily properties. I still am a multifamily broker. We have a team. We have team and groups across the country. But the biggest challenge with that is we've been taught that that's like basically the end all be all. In other words, we were taught that Blockbuster would be around forever, right? It's the best thing out. There's nothing going to be better. You just keep doing that thing. You swap until you drop. You get a stepped up basis, and it's just this incredible, amazing thing. Now, that being said, there's a time and place to use the hammer. Let's call the Blockbuster hammer. You can hammer the nail, right? Like if it works, meaning you have the exact property you want to buy, or at least a really good property you want to buy. You have a great debt situation in place. You have hopefully positive cash flow. You have a good value add opportunity where you can force appreciation by improving the units or improving the property or adding a tenant, whatever it might be. And that way you can defer the capital gains tax. It's a great way to build wealth until it's not. Now, when is it not? During shifts in times of change and uncertainty, right? Which does what? You get what's called your cash flow not in sync with your tax flow, or the biggest one is your debt flow, right? And that's the part where most people are not thinking on a mindset with these three things involved. It's almost like seeing, those old cartoons of Walt Disney and the 1D, right? It's just a flat piece of paper, and it's the Mickey Mouse going on, right? And then they went to 2D, and then went to 3D. Well, wealth in today's marketplace, we believe you need to have a 3D approach and a strategy that allows you to move in 3D, right? Debt flow, tax flow, and cash flow. So with the 1031 exchange, one of the challenges with it is you're not able to diversify. You're not able to be out of debt when it's not a great time to be in debt. You're not able to be liquid, right? And it means you're forcing typically a situation which you probably is not ideal for you, especially when interest rates are higher than most cap rates. So enter the deferred sales trust. We can solve all of those problems. So we call it the Netflix version to the old Blockbuster, meaning you can be debt free, you can be tax deferred, right? You can be diversified, you can be liquid, and you can wait on the sidelines in optimal timing and invest when it makes sense for you. And that's important, right? Because at the end of the day, what is wealth for except to give you some freedom and help you to make an impact, right? And if you're not having a plan that gives you that time and that flexibility, it can prevent those freedoms, right? And I think about a client of mine, Warren and Catherine. They sold a $2.5 million property. I helped them actually sell that as a broker as well in Sacramento. And they had two twin daughters. They had these two twin daughters a little bit later in life, and they're wanting to maximize their time and their energy. And Warren just retired, working at the hospital for like 25 years. And Catherine is, they wanted to travel, and Warren's finding himself having to drive a couple hours in traffic on the weekends to do something with the property. There was always something. Now they had property management, and the property was a great property. It was actually in Placerville. These are larger units. They're all fully rented and occupied, and good cash flow, about $120,000 of cash flow. But he was saying, Brett, I was finding myself trading a lot of my time and my energy. And typically we call the T's, the toilets, trash, and termites, right? And those are the three big T's, let's just say, of owning real estate. Can be kind of frustrating. And he had these two twin daughters. So he was trading his three T's on the toilets, trash, and termites for his really more important two T's. And the one big other T that's a part of this is the time that it was taking away from his twin daughters at this age where before they're 18, as a good stat I saw recently to help me remind me to stay focused on my kids while they're below 18 is that 85% of our time, Dan, is spent with our kids before they're 18. Right. Once they're 18, it's like they're launched, and we've already spent 85% of the time that we're going to spend with them personally is already gone. So it's only 15% less. And so when he learned about the deferred sales trust, he goes, Brett, I have 15 problems, if you will, 15 units. He goes, I didn't want to trade 15 problems for 30 problems. That's probably just going to increase my time with real estate. Right. And so for him, the deferred sales trust unlocked that freedom of time and energy to spend with his family. Plus, guess what we also did? We increased his cash flow. So it's not just a freedom part of it. It's also, we're looking at the cash flow. What was cash flow? Went from about 120 to about 190. So he's like, Brett, I can increase my cash flow by 70,000. I can get rid of the termites, the trash, the tenants, as far as the responsibility. I don't have to deal with rent control or increases in life and insurance for all the insurance going way up. The fires, all of the challenges that California brings, and I can go and not have to worry. He goes, Brett, I didn't know how much of a weight this was on my shoulders until about 3 months afterwards. I'm going, oh, this is nice, right? So that's the big part of why we really focus on that time piece versus the 1031 exchange.
So just a follow-up question on that. You talked about, increasing freedom, increasing the cash flow, but what about also increasing buyer opportunities? Because it seems like with the 1031 exchange, you got the 45-day window to identify, and then you have the 180-day to close. And so you're if you're selling at a high point, you're also going to be buying at a high point. And so it seems like the DST also provides another opportunity to give you the freedom to generate a return short term until the market's in a more ideal situation for you to enter back in and buy. Can you explain a little bit of that?
Yeah, that's exactly right, Dan. We call that the optimal timing, right? Sell high and buy low. And in fact, it's what our parents taught us to do, right? It was pretty simple. Sell high and buy low. If you just do that, it's great. But why that doesn't typically work with the 1031 is because you sell high and you have that 45 days to identify that property and then about 135 days left to close. And that is the challenge, right? With the 1031 exchange is you typically cannot shift the timing of the marketplace, okay? And so with the deferred sales trust, on the other hand, you can. In fact, part of Warren and Catherine's strategy is we've sold high, we've diversified. We have also put the money in mostly like a lending fund that's paying about 10%. That's a group that manages and operates over 25,000 multifamily units and is a professional private equity real estate firm that has never lost a dollar, never not paid 10%, and never missed a target, never not paid a preferred return. Like they're doing great, right? Just doing really great. And you can typically get the money out for their lending fund in about 30 to 60 days, which if you combine that with the thought that the cash flow on Warren and Catherine was about 4% max on their ROE, return on equity. Now we're like at 8, 9, 10%, even net of fees. I mean, they're jumping, they're doing backflips with how cool this thing is. But that doesn't restrict them from going back into their own deal. And that's the whole cool thing, right? In fact, in 2008, when the crash hit, it took 3 years for the real estate market to hit the bottom. Well, obviously a 1031 is not going to work because you don't have a 3-year window. But what can you do with the deferred sales trust? We've sold high, we've diversified, and we can wait for the market to shift to a lower price. Then we can partner with the trust and we can buy these deals. In other words, it doesn't prevent you from doing what you wanted to do, which is own and manage and run real estate, if that's what you want to do, right? Some people want to be retired. Some people want to be an entrepreneur. The deferred sales trust is for both. But best of all, it's for those seasons of life. Like we have another client, his kids, the kids are 13 and 14, and he wants to maximize his time with them. So he sold a business to maximize the time with them, to be able to defer the tax and really, really gain back his time. And then once the kids are in college, he's like, well, then I can go back to being an entrepreneur and pursuing these things. But the business was doing really well, and he wanted more time with him. And that was a great way for him to experience the freedom with this. But again, it doesn't prevent you from buying more real estate, all tax deferred, when the timing is right.
Fantastic. Thank you for sharing that. Now, I've got the privilege of sitting in on some of the calls when people are wondering if the deferred sales trust is actually for them. And, of course, they have to have a $1 million gain to make it make sense. But you've also sat down, and this is a question I have, and you've calculated with them the return on equity of what they're currently doing. How do you calculate that, and why is that a significant part of your process?
Yeah, absolutely. It has to make sense financially, or it doesn't typically make any sense. And so, by the way, if you haven't already got an HP 12C, this is a really cool calculator. And I wish someone would have told me about this at a younger age. And it's a neat calculator because you can really organize your thoughts and the numbers in a systematic, simple way. Okay. So if you haven't already got one of these, I encourage you to get one of these. This is amazing. I think this is the best way to teach your kids, your grandkids, how to calculate numbers versus the standard calculator. Okay. So we always start with some of the basics, right? We're going to start with how much is the property worth, right? In other words, are you sitting on land that you bought for $100,000 in Texas, and it's really worth $15 million because there's oil underneath it, right? And you're just sitting there, you're not doing anything with the oil, but someone will pay you $15 million so they can start pumping the oil out. So you're in it for $100,000. It's not producing any cash flow. And you're like, well, that's not great, right? We want to get that money and the equity working for us. And so the first thing we do is we figure out the price. So let's just use that scenario. Let's just say it's a $15 million property or business. And let's say it's land. And let's just say that land is really only producing, you might be leasing it out or to like a farmer or somebody who's doing something there, some crops or something. And let's just say they're paying you even $500,000 a year, right? Okay. You take that $500,000. Now, if that is your, after property taxes, after insurance, if you have insurance, all that stuff, let's just say you're netting $450,000, right? $450,000. So you're going to take basically your cash flow, income minus expenses. If you have debt service as well, in this scenario, we're free and clear, keep it simple. But basically, what are you making per year? In this scenario, it's $450,000. I'm going to take that $450,000 and I'm going to divide it by the $15 million, what I could sell it for. Now, let's assume that's net of closing costs, because you do have to pay a broker perhaps, and you have some closing costs. But let's assume it's 15.5, you minus the closing costs. So I'm going to take that $450,000, divide it by the sales price minus the closing costs. In this scenario, we'll say it's $15 million. And that's going to give me a 3%, 0.03, 3% ROE, return on equity. Now you look at that and you go, well, that's not necessarily great. It's not, because you can go into money markets and make 4 to 5% right now, right? That's pretty staggering, right? You can go into the lending fund with the group we work with and make probably about 10%, which is pretty compelling, right? So that's the simple math. And so that's the first thing that we do. Any questions on that first part, Dan?
No, that's great. And then, I just noticed when you've gone through that process, which I'm just understanding now, and then you show them if they use the deferred sale trust, what that's going to increase to. People have been very excited about that, to say the least.
Yeah, let's walk through that, right? So this is a great example. And so I typically say, okay, what are you making per year? They're like 450,000. I say, great. I said, divide by 12. It's like 37,500 a month, right? And then we say, well, what after closing costs, after fees, let's say we net around $15 million, right, into the trust. And let's just assume a 5, 6, 7, 8, or 9% interest rate. Let's just use a 7% on this scenario. And then we typically can do that net of fees. Okay. That's $1 million. That's over $1 million. Okay. So we've just increased their cash flow on a $15 million exit to $1 million from 450. So then I like to take that $450,000 number, okay, and I like to divide that by that $1,050,000 number. And that's a substantial return, right? That's over 60%. In fact, it's about 67% increase. In fact, I'm sorry, it's over 100% increase. I'm sorry, you're looking at 450. You're doubling that, right? So more than doubling that. Plus, or another way to do it is $1,050,000 divided by 450. It's 2.3 times more. So that is a substantial increase in your cash on cash return, which is huge. So it's say, well, what would it feel like to have, divided by 12, about 87,500 versus, 37,500. At this point, people are excited. The math makes sense. Any questions on that, Dan?
No, I'm just laughing because I've been in all these meetings with these potential clients, and you get to that point where you say, "Hey, how does it sound for to have double the cash flow or triple the cash flow?" And just like you're saying, they're like, of course." And so I think at that point, the only question they really have is like, how do we do this? What does it look like? And the thing that I think really, makes people say, yeah, I got to get on board with this is the two things. Number one, that there's basically no pressure to do the DST. There's zero cost for due diligence. But then also, if they decide to move forward, there's a lifetime audit defense that's connected to it. Can you talk about that?
Yeah, let's touch on fees, and then let's touch on the lifetime audit defense, right? So there's really kind of two sets of fees, right? There's the one-time legal setup, which includes lifetime audit defense with the DST tax attorneys that we work closely with to form these. Okay, and so they do all of that, and as a part of that too, we all work on a conditional engagement, meaning if for some reason the deal doesn't work out, the buyer doesn't buy, or you just don't want to use the trust towards the end, which is pretty rare. Most people, when they get with us and they get engaged, they see it through. But even if you didn't, no problem. There's no pressure. You don't have to use it. You owe us zero. There's no obligation. Okay. But the fee is basically 1.5% of the gross sales price on the first million, and then 1.25 on anything above. So let's just say it's a $3 million transaction as a gross sales price, 15,000 on that first million. And then you take that second, the remaining 2 million, you do 1.25%, it's 25,000. So the total is about 40,000 would be the legal fee on that $3 million deal. On the $15 million deal, it would be larger. It would be 1.25% on the 14 million, and then 1.5% on the first million. And again, that's a one-time fee paid only at close of escrow if the deal closes and if you use it. It covers lifetime audit defense, which also we'll touch on this right now. It's over 27-year track record, thousands of closes, billions and billions and billions of assets, gross asset sales values used it over all the years. Cryptocurrency, business sales, primary homes, businesses. Of course, we've also saved failed 1031 exchanges. We do have the best 1031 exit plan, by the way, which allows you to have a traditional 1031 exchange, the full service, along with the deferred sales trust as a backup plan, and have our team help you navigate that through. As well, be able to use the Delaware Statutory Trust in case you need to use that for some debt over basis challenges. You can go to experttaxsecrets.com to learn about that. That's the first fee, okay? The second fee has to do with the actual trustee management, okay? And that's our company, Capital Gains Tax Solutions. So the way we earn capital or earn our fee is by basically managing the trust and helping and aiding the compliance, the tax returns, the profit and loss statements, the reporting, connecting with a lot of times certified financial planners, connecting with real estate groups that are investing, and essentially that is our role as the trustee. And we get paid along with everything, including all of the advisors, anyone else that we bring in. Is typically it's about 1.5% to 2% on a recurring basis, year in and year out, on the net proceeds. And so if you sold something at $8 million and you had a $5 million debt to pay off and only $3 million hit the trust, well, we get paid just on that $3 million. Now, if you sold an $8 million deal and all $8 million, no debt, goes in the trust, we get paid on the $8 million. So that's a simple math on that. If it goes, the higher it goes, you get some fee breaks along the way. However, we're typically able to return 6, 7, 8, 9% compounding net of those recurring fees. The second part of the way we do that is we cash flow our fees. And this, I think, is unique to us as well. The way we structure it is that we're going to get this plane off the ground at the sale, and we're going to wait typically 2.4 months in order to get the interest accruing and earning on the trust, and then it pays us. In other words, we're delaying gratification. We're aligning ourselves with the trust long-term success and your success by not charging those fees at closing. Campbell, the law firm we work with, they charge at closing, but we charge along the way. So hopefully that answers the question. There's also a tax return fee, maybe some bank fees, add up to be around about $1,500 to $2,000 a year. However, even net of those recurring fees, we're able to return that typically 6 to 9% down.
Yeah, two things that jumped out to me about that. Number one, you said exactly what I was trying to remember, but I couldn't. Conditional engagement. So people can enter into the process, and unless they utilize it, there's no charge. And so that's just, I think that's like a really cool thing that you guys offer. And then if they do it, having 7 to 8% net of fees is just unbelievable. And I think that speaks to your strategic partnerships, the investments that you offer to your clients. Can you talk about some of those?
Yeah, this is so important, right? Because the way we approach this business is as real estate investment advisors that happen to be trustees, okay, for the deferred sales trust. So the deferred sales trust is the tax strategy and product. We are trustees. That's the service we're offering. But the bigger picture is approaching this to try and help you achieve amazing success in real estate investments, whether that be passive or active. And so our unique skill set has helped us to become the top DST trustee service in the country because of that background. And most of our clients, they are real estate or business entrepreneurs or crypto millionaires, right? And they're looking more for those types of investments versus traditional stocks, bonds, and mutual funds. Nothing wrong with stocks, bonds, and mutual funds. But most of our clients really want to be able to do business, entrepreneurial, real estate, cryptocurrency. That's just where they feel most comfortable at, okay? And so that's who we are too, by the way. That's how we've made our wealth, and that's how we've built our business, is with those types of assets rather than the stock market. However, we also bring in those certified financial planners. We bring in some of the best in the country to get a balanced team. In fact, I think that's the way, going back to the basketball analogy, right? And using, let's say, Steph Curry as an example. He may be the rare exception, but a team, you typically need, 5 unique skill sets that are all working and bringing their best to the table, right? So you might need a Steph Curry. You may need the Draymond Green if he's not getting kicked out of games. You need the Klay Thompson, right? You need the Steve Kerrs, the coach on the side. You need the whoever else it might be, right? And they have a lot of lineup changes recently, right? But the point is, you want 5 groups that are doing unique skill sets. And so that's what we try to bring to the table is unique skill sets in each area to get a well-balanced approach for building your wealth plan and with the DST. And that's a key distinction here is that we try to build let's call a family office approach, right? Where we're bringing in some of the best in the entire country to form this team to help you. Now, by the way, you might already have a team. Great. We work great with teams. We can fit right in there, right? And we can just be that trustee. And you might already have a team that you can bring in. Fantastic. You might be looking for a new team, right? That same group that helped you get from 0 to 10 million may not be the same to go from 10 to 100 million, right? Or 100 million to a billion. We want to find the best talent and bring in the best team and also introduce you to some of the best real estate proven operators in the country. And typically a lot of our clients like a diversified real estate approach that have some semi-liquid options. And so now to answer your question, Dan, the trust and the tax strategy can be the most amazing thing. And the legal part can be completely awesome and dialed in. But if you don't have a great investment experience, or a great investment, outcome, then it's like a 3-legged, stool. The thing falls down. You need all 3 legs. You need the legal track record, the legal team. That's their role. The tax attorneys we work with. You need the trustee and the kind of the day-to-day and the execution of the business plan and the trust. That's our role. And then you need the investments that we're going to be going into to actually get the return on the trust, right? To be able to pay you back. And so with those 3 combined, we are focused like a laser to find the most amazing groups. And so we work with groups like DLP Capital. We work with groups like Praxis Capital and Ashcroft Capital and Sunrise Capital. These are mobile home park, multifamily operators. We like some self-storage. We like some industrial. So we have groups that we work with there. And these groups have proven track records, excellent returns, a phenomenal leadership and culture that they've built. And these are the groups that we make introductions to. A lot of our clients already know them, which is nice too. And from there, we've been able to have some great success.
Okay, so those are most of my questions. So I got a final question here for you related to capital gains tax solution. So, when they form a deferred sales trust, they have a trustee, which happens to be you. And so I think you're a very important piece to the strategy. And today with our whole team, you drilled in the mission statement that capital gains tax solution exists to unlock capital gains, to release freedom and impact for our clients. So can you explain to the listeners why that's the most important thing for your company?
Yeah, it's literally everything that we're about, and it started out. For me, I got to start with my family at a young age in real estate wealth in the Bay Area, doing great. Everything was doing really well for a number of years, and then until it wasn't. Until my parents got divorced at a young age, and I saw the direct result of what a divorced family, where my dad wasn't paying child support for my mom and I and my brother who were living, and we went from both sides, right? We would go to my dad's place, and we had the Harleys, the boats, the camping, the went to Disneyland. We do all the cool things. And Dad was great. He loved us, and he kind of spoiled us, and he taught us to work really hard. And he was an entrepreneur. So I love my dad, but he and Mom didn't get along. And so we go back to Mom's house, and we couldn't afford the car, right? We're living with my grandma. We were, let's just say lower middle class, right, if you will. And we didn't know the difference. But what really the point was, we saw how wealth can separate families, right, and cause that division. And so for me, looking at the deferred sales trust and even just wealth and helping people with real estate has a deep thing that I never wanted wealth to come between myself and my family, right, and my kids and my marriage and all of that. Everything was kind of my world was that. And in fact, in 2008, the market crashed, and I found myself like at a place where I'd been very successful in school and basketball scholarship at college and had a great internship that turned into a full-time career at Marcus and Millichap. But I was flat on my back financially and didn't know what to do. And all of a sudden the fears and the frustrations all start bubbling up, and I'm newly married and trying to be an adult, right? Try to really be, an adult with my wife, and we have a baby on the way. And all of a sudden we're going, oh my gosh, what are we going to do here? We're not making much money. And so I'm at Marcus and Millichap, making these cold calls and trying to figure it out. I'm also working side hustles at a place called Cheesecake Factory. But the fears and the frustrations of all of that lack of freedom and lack of margin with my capital came, my parents were growing up with my mom, came flooding back. And all of a sudden I'm facing these challenges and I'm going, oh my gosh, is this going to, hurt my marriage and hurt my family, And so that kind of drove me to look at strategies, because at the same time, my clients who had made $1, $5, $10, $20, $30 million of wealth, built up portfolios of $50 million of apartment complexes, and some of them are losing half or everything. And I'm looking around going, well, there's got to be a solution for that. So they're going through these two things. I'm going through mine. They're going through theirs. And that's when I learned about the deferred sales trust. And it became very clear that if this is true, if this is the Netflix or the Blockbuster, this can make the changing of the real estate industry forever, right? It's no longer just 1031 exchange. It can be freedom. It can be flexibility. And it can make a huge difference for families, right? Who do feel trapped in some way by the property, by the toilets, by the trash, by the liability, by the timing of the market, by the debt, by the banks, by the rent control, by partnerships, by certain assets that don't work for capital gains tax. And that's when it began the journey of just sharing what could be possible. And I was cautiously optimistic, right? I was asking the same questions. Is it too good to be true? Will this ever work? How many people have really done it? What are the closed deals? But then I just start closing all the deals. And now we have all the deal closes, and I start seeing the transformation for these families. I start seeing the transformations for for the freedom and time and energy. And so here we are now. We've tried to express and share as much as we can in our book right here, Building a Capital Gains Tax Exit Plan, and our YouTube channel, Capital Gains Tax Solutions, and with our clients to kind of build kind of a movement here. And so again, we exist to unlock capital gains, to unleash or unlock freedom and impact, right? And freedom is different for everybody. It could be that freedom of margin for your time and energy with your family. It could be the freedom to be able to give to causes you believe in most. It could be the chance to move out of California, move out of a partnership. We had clients, 4 clients that they build car washes, and they each wanted to have their own trust, or one of them actually wanted to pay his tax. He pays tax. He's a small owner. The other 3 wanted to build their own trust to get some flexibilities and diversification. So it's different for everybody. And that's the cool part. I mean, we look at this business sort of like in a Rubik's Cube. I think I usually have that around here, where each situation is a little bit different, but we really want to drive home that it can unlock the transformational exit planning versus just transactions. And that's hopefully that answers the question, Dan. That's the best I got today on a Friday.
Yeah. Hey, that was fantastic. And, I think for anyone listening, getting to know you a little bit is very important, because you do become the trustee. And one of the reasons I joined you is because I've known you since you were 14, and I have great trust in you, but also meeting your clients and seeing the relationship and the freedom and impact that you're releasing in their life through Capital Gains Tax Solutions, something I wanted to be a part of. So thank you very much, Brett.
Dan, absolutely. It's an honor and a blessing to have you aboard. And I want to thank you for even just 30 days, how far you it's great. They say to get in a room with people that are smarter than you. And so I'm just trying to bring people in a room that are smarter than me and more mature and all those things, right? This is great. We're going to team up and do a great job together to help a lot of people. By the way, if you want to get in touch with Dan or I, you can go to capitalgainstaxsolutions.com. If you have a deal that's $1 million net proceeds, $1 million gain, at least to qualify, you can schedule a one-on-one consultation with me or Dan or one of our team members, and that'll give you an opportunity to dive in a little bit deeper to see if it could be fit for you. We also have a free ebook there. It's pretty cool. You can check that out. It's a free ebook. And then don't forget about 2 other things: the best 1031 exit plan. Friends don't let friends do a 1031 exchange without a backup. Without a parachute to jump out of in case it fails. And so you want to make sure you get the best 1031 exit plan. Go to experttaxseekers.com for that. And then the book is on Amazon. It's called Building a Capital Gains Tax Exit Plan. We hit #1 bestseller in a couple categories on Amazon, which is pretty cool. And you can check that out on Amazon. And that's really it. We'll be back with more basics coming up here, maybe about once a week. We'll be on here. But appreciate everyone watching this. Please
Pretty
share.
sure they're all Steph and Seth Curry already from the foundational truths they learned today.
Exactly. And if you know Steph or Seth, we'd love to have you on the podcast and we can talk about some hoops and some fundamentals. And I've got a 5-year-old son that I'm hoping to be like a Steph or a Seth Curry. That would be really cool. So yeah, anyways, enough about that. We appreciate everybody and we'll talk to you again.